basically, I think the thing, rather than being specific and relying on some analyst's analysis of this miner or that miner, this one's a dog, that one's good, I think you could throw darts. I think the whole pack of them is going to go up because the power that will drive them isn't going to be what's the profitability of this company versus that.
Right.
It's basically, my God, an underpriced category, and money will just flow into it. And even garbage stocks will go up.
Michael Oliver, a veteran technical analyst with 5 decades of experience, has completely revised his silver forecast. He's no longer calling for $60 to $70 silver. Instead, he now believes silver could reach $100 to $200 within the next 2 quarters. His reasoning? Silver has been stuck in the same price range for 50 years, while gold has broken out multiple times. Other commodities like copper and lead have already quadrupled and moved into new price realities. Silver is massively overdue for the same kind of explosive move. The key trigger Michael is watching is the silver-to-gold spread. When silver breaks above 1.31% of gold's price on a monthly close, he believes the clock begins for silver's parabolic move. We're currently at 1.2%, meaning we're extremely close to this critical breakout level. Michael also sees massive opportunity in silver miners, which remain deeply undervalued compared to gold miners. He believes they could deliver even more upside than the metal itself, as investors wake up to the fact they're essentially buying silver at 10 cents on the dollar. With momentum indicators flashing bullish signals across precious metals and the broader commodity complex, Michael believes we're entering what he calls a new reality for silver prices. Thanks for watching. Subscribe to Fine Metals for more insights on commodities and precious metals markets.
You can't fake reality forever. And if gold, the other monetary metal, has gone from a peak in 1975 at 200, then in 1980 was 850, and now we're 4,000, and yet silver in 1980 was 50, and we're at 48. Okay, now something's wrong there. Forget any intricacies of special situations. What's going on? I mean, lead's 4 times its price then. Copper is. Is silver, anyway, there's a point to be made there. Sometimes markets make mistakes. We know that. As an investor, if you're around long enough, you've seen bubble markets make a peak. And when it falls apart, you look back and say, oh, golly, now I can see why. It was irrational, too high for too long. Even if the concept underlying it was valid, it just went too far too long. And the same thing goes on the downside. Markets make mistakes on the downside. They get down too low. They lay there. Nobody likes them. They're not doing anything good. So who's going to invest in them? And then when they wake up in a thunderbolt. The technicals of silver right now argue to us. Now we've got one trigger level that we'll talk about in a minute. That when it's triggered, we think over the following 2 quarters or so, in other words, 6 months or so, silver could go to at least 100, more likely to 150 to 200. In other words, you could quadruple its price in a matter of a couple quarters. It started in 2001 from a $260 low and went to 1920, 8-fold move. Spanned 10 years, but an 8-fold move. Okay, we're only 4-fold off the bare low, $1,050 in 2015. So people say, oh, it's overdone, it's overdone. There's another argument that it's just beginning. And it's the first charts I sent you. The first chart shows a spread relationship between an ounce of gold and the price of the S&P 500. And it goes back to 2013. Remember, gold peaked at 11. In 2011, 12, 13 especially, it's entered a bear market, which didn't bottom until 2015, end of that year. During that time, it was underperforming the S&P 500. The spread was collapsing along with the net price of gold. But then, in the 11 years since that, during an 11-year period of that basing process, there have been 4 rally highs in the spread, meaning gold has had a rally versus the S&P relative performance-wise. And each of those rallies, by the way, was actually strong upside in gold, net price. But there's a clear base that a kid with a crayon could draw a line across. 4 separate peaks that are almost flat. You're pushing at that line now again. Right now, the spread between gold and the S&P is 58.6%. Ounce of gold, D's gold, using D's front month future, S&P. If you ever close a month at 60%, and we were intra-month above that last month, you ever close a month out at 60% on that spread breaks out of an 11-year relative performance base. It says, I'm just beginning. Again, when the spread moves up, net price of gold's moving up. So that chart says, as an asset class choice, stock market or gold, it'll break out versus the S&P in saying it's just beginning. And then it's not broken out yet versus the S&P. But we also ran the spread of gold versus the New York Composite Index, which doesn't have a front end weighting of 5 stocks that constitute 30% of the overall index, like S&P, or 5 stocks in the NASDAQ 100 that constitute 50% of that index. Okay, I measured it against the New York Composite and the Dow 30. Same time span, 2013 to present. They've broken out. Already gold is broken out versus those two unfront-end loaded indexes of the U.S. stock market. The only thing that's kept it from breaking out against the S&P is, again, handful of those front-end stocks. That's it. That's the only thing. The broad market really gold's broken out. It says the game has just begun. I no longer have that view. I now think you could go to 100 to 200 in the next couple quarters. We've done a lot of technical rationale for that. It's not just a gut feeling, okay? But we've shown that if you look at silver on a chart, just an arithmetic chart, go back to 1975 when gold was legalized. Gold has had huge surge up, then a pullback and a range for a decade. Then another huge surge up and a new higher range for a decade plus. And now is into another surge, which is, by the way, only half as strong so far, measured logarithmic scale, ratio scale, to the prior 2 bull markets. If gold matched them, it'd be $8,500. Okay, but how come silver is stuck in this box for 50 years? We showed charts of copper and lead. Okay, real exciting stuff, lead, But in the 70s, 80s, 90s, and into 2000, they were stuck in a range, sort of like silver is now still stuck in. And in 2005 and 6, copper quadrupled in about a couple quarters. It just left that old reality behind. And then over the subsequent decades, a new range that if you divide the middle of that range it's been living in for the last 15 years or so, it's 4 times what it was between 1970 and 2005. Okay. How come silver's still stuck in that range? Then we look at lead, and lead had the same situation for multiple decades, caught it at a price range, blew out of it in 2007, not in sync with copper on its own stuff, quadrupled in price in a matter of a couple quarters, and then lived in a new reality. I argued that silver is going to explode, but you can maintain a spread chart where you divide an ounce of silver into an ounce of gold, express it as a percent. A lot of people do it the other way. It's a ratio chart, but we do it ounce of silver to gold. And right now, silver price is about 1.2% of the price of gold. Okay. If you go back and examine what happened in those 2 prior bull markets at the phase where silver went ballistic, we had been going up for a couple of years, 75, 76, 77, 78, 80 finally. In the last 6 months of that move, silver went quadrupled in price. It had already been in a bull. It wasn't like it wasn't a bull then. It just said, I'm gone. Okay. And in 2010, September of 2010, 6 months before silver reached 50 again, in April 2011, it doubled in half. in 6 months. Okay. You want to quadruple silver from where it is now, you're talking 200. Okay. You want to double and a half, well, you're talking, 125, whatever. Okay. What was a signal back then that that event was going to occur? Because when you looked at the price charts, they were already going up. So it wasn't a big deal that they just went up faster. Okay. So the price charts weren't telling you. You'd already been in a bull trend. The spread. Divide the ounce of silver into an ounce of gold and plot it month to month. And sure enough, back then, even while silver had been going up for a couple of years along with gold, 76, 77, 78, 79, okay, it was going up less. And therefore, the spread was deteriorating. Silver was underperforming the advance in gold, so it looked negative on a spread chart. It was still making money, but it wasn't as much as gold. The spread built a structure. My own personal investments, which I have to disclaim at the end of all our reports, is what do I own? Okay. I'm wholly emphasizing silver and silver related. And I think some of the miners might be as much bang for the buck, if not a lot more, than what silver might do. And the reason is they're still very lagged to the gold miners historically. They're very lagged to almost any way you want to measure it, to gold. Or the silver miners are the real dogs. The gold miners have gone up, and notice GDX, for example, had a high in 2011 in the 60s. Well, it went up to $80. Okay, pullback, and right now we're like 68 or 70. I think we're 70 area. Okay, so it had a pullback, but it burst through this at like a doubling in price in a matter of a handful of months, just to get above the 2011 high, which, as we know, gold's way above that. It was $1,920. Okay, so the gold miners said, I'm here too. I'm back. Okay. The silver miners aren't above that high. For SIL, for example, that high in 2011 was at 90. And we didn't get there. I think we're going to get there and then some. I think it's, again, sort of the phenomenon. I'm talking about what I think silver's going to do technically. The silver miners perhaps should best be viewed not as miner by miner by miner analysis, but more as, hey, they got the stuff underground and it's not priced at even the per ounce level. Okay, you're in effect buying silver bullion at 10 cents on the dollar, okay, by buying the mines. And I think that acknowledgement will come when silver runs its tantrum move. It goes to the new reality. And I think at that point, you want to be long silver. Perhaps if you want to, silver calls that go out a year, let's say, and the silver miners, as opposed to gold and the gold miners, which will also be going up, but less so. So I think it's the focus now should be on the silver component of the monetary metals. Silver's now going to beat gold. That's what set off the fuse. Same thing happened in 2010. You'd had a depressed action by silver to gold. It built a spread dynamic that you could see, draw a ruler across it. And in September 2010, you broke out, and that's when the price of silver went ape. We have a very similar situation on the chart I sent you. There's two charts there. One is the spread chart at the top, and you can see there's a red horizontal line on it. Comes to just above 1.3%. Again, we're right now at 1.2%. You ever get a monthly close above 1.31%? Actually, it's where those precise two prior highs were going back 4 years. That breaks out and says, I'm out of here. And you're still at very cheap historic values of silver to gold. Heck, 20 of the past 50 years, silver's at least been 2% price of gold. Well, heck, if you go from 1.2 to 2, that's a huge multiple. I mean, silver's almost doubling in value to gold. And in bull markets, going back 50 years, during the 79-80 move and the 2010-11 surge, silver reached well over 3%. So from 1.2 to 3, well, wow, okay, huge potential multiple. The key is to break that spread out. Now, the chart below the spread, pardon me for getting scientific here, is a momentum of the spread, where we measure the spread in relation, oscillated versus its 10-month average. And you should have the same picture. Dual highs, you want to break through them. Well, heck, last September, we closed on the line and backed up ever so slightly into October. It won't take a hair's breadth to break out the momentum above its ceiling. And when it does, you can bet that the spread will follow. So those are the metrics we're watching that tell us the clock has begun. The clock for the go into a new reality. So that's what we're focused on now. Gold's already outpaced the stock market, except for the S&P, and it's ready to do that. But when silver breaks out versus gold, it's telling you it just began. You haven't gone ape yet. Everybody thinks it's gone crazy. No, it hasn't.